One of the most important inventions in human history is the concept of money. But before money, there was something else. It was not just bartering, but something more powerful and human. It was credit. Credits are built on system of trust, and when such system of trust is used or borrowed, it becomes debt. In this video, we are going to discuss the evolution of credit and talk more about how it developed across ancient civilizations, medieval societies, and modern times, and why credit still matters today. And so, let's start with the video. The word credit has deep linguistic roots. It comes from the Latin word creditum, meaning a loan or something entrusted to another. This evolved into the Italian credito and the French crédit, both of which roughly means belief, faith, or confidence. Credit is the belief and trust in a borrower's ability to repay debt. The concept of credit is not just limited to money, but it also extends to other resources. Consider a library. Borrowing a book means being trusted to return it in good condition. Or think of a neighbor who lends you an egg, believing that you will return the favor one day. In both cases, it is credit, or rather trust, that enables us to exchange goods and services. Credit and debt are closely connected but not identical. Credit is the trust that allows someone to borrow. It comes first. Once the credit is used, it becomes a debt, an obligation for the borrower or the debtor to repay the lender or the creditor, either in money or in kind. The concept of credit is very old. The earliest records of credits date back to ancient Mesopotamia, where clay tablets were used to track debts and promises to repay. In ancient Mesopotamia, workers were often compensated with barley, a staple crop that also served as a unit of value. But this was not simple barter. Barley was measured, recorded, and widely accepted, making it one of the earliest forms of commodity money. Even earlier, people were tracking debts. In Sumer, officials recorded what someone earned or owed in grain, beer, or labor. These records were etched onto clay tablets using cuneiform, one of the earliest known writing systems. Many of these tablets, though some remain undeciphered, have been found in Sumer and Babylon, revealing a complex economy built on obligations. In ancient Egypt, credit was grain-based. Farmers deposited their harvest in state granaries and received written receipts. These acted like withdrawal slips and could even be transferred to others. In classical Greece, credit played a vital role in trade and everyday life. Wealthy individuals often lent money to others, charging interest. These agreements were usually written on papyrus or wax tablets. The loans were often secured by land, others by the borrower's labor or property. Rome developed a more formal credit system. Bankers, called urgentari, recorded transactions, offered loans, and transferred funds. Roman law recognized contracts, and failure to repay could lead to legal punishments, even slavery in early periods. In India, merchant guilds functioned like early financial institutions. They issued loans, accepted deposits, and used hundis. written credit notes for trade across cities. These were honored based on trust within merchant networks. China too had a grain-based credit system. State granaries lent grain to farmers during poor harvest, expecting repayments later. Under the Tang and Song dynasties, more advanced forms of credit emerged, including promissory notes and early forms of paper currency. During the Middle Ages, merchants began maintaining detailed ledgers to track debts and transactions. To avoid carrying heavy coins over long distance, they used bills of exchange, written promises that could be traded, sold, or redeemed in other cities. These made trade more flexible and far-reaching. Travelers often carried letters of credit, allowing them to access funds from distant banks, which made cross-border trade safer and more efficient. Interestingly, the concept behind these tools was not entirely new. The word check comes from the Arabic word sak, which referred to written payment orders that were used by merchants in the medieval Islamic world, enabling long-distance trade without physical money. In the Renaissance, powerful banking families like the Medici transformed European finance. They operated across multiple cities, introduced double-entry bookkeeping, and refined credit instruments to a high level of precision. One of the most important figures in this transformation was Luca Pacioli, a Franciscan friar and mathematician who wrote the first known book on double-entry accounting. His work became the foundation for modern accounting. While the Catholic Church officially banned interest or usury, workarounds emerged. Religious orders like Franciscan and charitable institutions such as Monte de Pieta offered low-interest loans to the poor. Meanwhile, theologians began to argue that charging interest could be justified under certain conditions, for example, when it compensated for lost opportunity or risk, an idea known as lucrum cessans. By the mid-1800s, consumer credit began taking shape as lenders moved beyond personal trust and started maintaining shared records to evaluate borrowers. In 1841, the Mercantile Agency, later known as Dun and Bradstreet, was established to provide credit information for businesses. A major leap came in 1950 with the introduction of the Diners Club card, the first widely used charge card, which let consumers pay for meals without carrying cash. This innovation was soon followed by Bank AmeriCard, later Visa, and the American Express card in 1958. During the late 19th century, firms like R.G. Dun and Bradstreet systematically collected credit data, laying the foundation for today's credit bureaus. In 1989, the launch of the FICO credit score introduced a standardized way to assess individual creditworthiness using a scale from 300 to 850. In the modern era, central banks closely monitor both personal and national debt. At the same time, credit rating agencies like Moody's, Standard & Poor's, and Fitch, established in the early 20th century, have become central to evaluating the financial health of corporations and governments around the world. Credit remains a cornerstone of modern economies. It enables individuals to buy homes, businesses to expand, and governments to invest in infrastructure, all before they actually have the funds in hand. This fuels economic growth and innovation by allowing people to take calculated risks. But credit also has a darker side. When overextended or poorly regulated, it can create bubbles like the 2008 housing market crash, leading to devastating financial collapses. To conclude, credit plays a major role in our economies. From ancient times to present day, credit gave us the benefit of not having to carry money at all times. Although modern credit systems differ from ancient ones, credit still functions on trust. Without that trust, the entire financial structure begins to crumble. With that being said, what is your view on credit? Feel free to share your thoughts. Until then, see you in the next video.